Test, test, test. Okay, there we go. Okay, there we go. Okay, should be good. I see my sound working now. Sorry about that, guys. Let me actually put up this poll here one more time for everybody. How much will rates go up? There we go. Let's go 0, EPS, 5, BPS. There you go. And hey, man, sorry about that, guys. My Streamlabs software wasn't actually like getting my microphone in, but everything else was, so I had to restart my software here. It sucks, but that's what it is apparently right now. So BPS here, and Loki says hello as well. Oh, he just jumped down. And then one more thing. I'm just putting up a poll question for you guys again. I just want to do greater than 50 BPS. There you go. There we go. Okay. There we go. All right, everybody. Hope you guys are having a fantastic morning here. Hey, Alex. Hey, Melvin. Hell Crypto. And Loki's over here. He wants something. I don't know. Okay. Should be working now. All right. So, hey, everybody. Hope you guys are all doing pretty good. Loki had a fun little time hanging out. Oh, he's back from more. He doesn't like the camera watching him, but he'll be around a lot. He hasn't had a chance to go outside and play yet. Normally, I take him outside before stream, so he's a little bit more tired. Although he likes to say hello. Um, here, maybe this will work. So, okay, so yeah, that's Loki. He's a little lovable guy. Okay, look it down. Yeah, okay, there he goes. So today rate hikes are about to happen in the next 40 minutes. It's going to be a real big, exciting day. We do have rate hikes coming in 40 minutes, like I said, but it will take another half an hour after that for Jerome Powell to come out and start talking and doing his press conference, kind of elaborating what's going on here. Okay. Now, as far as the market's concerned here, let's kind of just zoom out just a little bit. Let me take off the divergences here just for a little bit as well. So, as far as the market looks, we still have a basic technical workout here. The SPY has broken out, and as of now, it's still managing to hold that support level. The fear here is since it's Wednesday and we have earnings coming up over the next few days, the fear is that somehow by Friday we're below the 50-week moving average and we're closing down below that. That would be more concerning to me, okay? Now, I want you guys to understand before we start talking about pessimistic things and stuff like that, if we do have a good rate hike of, let's just say, 25 basis points or less, and then things today with Meta after hours, which you guys should pay attention to, if that's good, if Google, Apple, and Amazon also have decent earnings, that's going to give the market an opportunity to have a very significant pump. Now, as far as the SPY is concerned, you'll see the same type of pattern happening with the NASDAQ as well. We're just going to have to break out above this simple level of resistance up here on 409. And once we're there, as far as the SPY is concerned, we can actually get back up here to 432. After we get back up here to 432, I think things get a little bit more tricky. This is more of what you might consider your typical ascending triangle here, if I can show it to you like that. All right, my head's blocking part of it. So where we're moving back up, we break out. It's a robust 2-week breakout or something like that. But then ultimately, we come up here, we get rejected, and then we start breaking down below this level. And then from there, we find another low somewhere over here. And that's if everything is good and rosy, okay? That's if everything is good and rosy. I think we should have a breakout, and at max, we get to 431. If we get above that, I would just be so surprised because this rally that we've had so far has already been so freaking, like, just crazy good, okay? Now, so that's my thoughts as far as SPY right now. If we do break out, watch for it to hit 431. Um, If you guys like to trade SPY with options, I would honestly just hit the 431 strike price for 2 weeks out and kind of watch it to see how it plays out if it does break out. But you're probably going to make that trade, I would say, on Friday or so, okay? Now, that's going to be hard because you still want all the earnings to be good. If the earnings are more mixed, we could still break out, but it might not actually go all the way up here to 431, okay? So I want you guys to really pay attention to earnings. Today's earnings, where you really want to pay attention to Meta, but tomorrow, that's where like just shit could hit the fan or the heavenly gates can open up for us, okay? That's really what you guys want to be paying attention to. Now, as far as the NASDAQ is concerned, you can see we've already broken out. We're still trying to hold on top. Let's go to the weekly chart. Similar, right? We, unfortunately, for as far as this one's concerned, we haven't actually broken out above that 50-week moving average, so that's our current level of resistance. You can see that resistance level right there that like SPY is going through. We don't have that for the NASDAQ. We've already broken out because of this robust, I mean, we've just fallen down so much more than the SPY, and that's pretty much why. But now, as far as this is concerned, the NASDAQ could probably make it all the way back up here to 12,767. Perhaps up here around 13,730, but I really just don't see that happening unless there's some type of really, really good news. I don't think there's news that good at this point in time, okay? So again, I think if we do have another big boom, it'll bring us up back up here. We'll probably get a little bit more choppy, and that's fine. But don't forget, as far as the SPY and the NASDAQ, we still have these death crosses occurring on the weekly charts. 20's already crossed. The 50's going to cross pretty soon. And historically speaking, when we do cross down below these, it's just not the best time. The good thing that can maybe disrupt this a little bit more, even though I'm more pessimistic, of course, is that we're dealing with inflation and rate hikes. I think because the Fed during COVID, right, during these last couple of years, printed so much money and just injected it straight into the economy, there's still so much money on the sidelines just waiting to hop into the market. So, you know, if any given point we feel like we're at the bottom, you know, people will just rush in and give us a little parabolic boost. Sure, the economy is going to get worse, I believe, and sure, I think any parabolic boom is going to be given back very fast, but you can still make money on those upswings, okay? Now, let's go back over here very fast. You know, as far as, you know, all of this talk as far as the NASDAQ and SPY and stuff like that, if you want to get more bearish, you know, you want to be more pessimistic, just wait for the trend lines to break. We're going on a nice uptrend here as far as the NASDAQ. SPY is in a nice little uptrend right up here. If we break down, that's when we got to start to worry. As far as the SPY, though, don't really worry about that small one. Worry about this longer one. That's what I'm more concerned about. But for now, we're testing at resistance levels. We're kind of going sideways, up and down, a little choppiness. It's okay. We can live with it. If you guys are looking for anything that's really moving today, it seems like NVIDIA is probably one of the only few, along with AMD, because of the earnings that AMD had last night. And oil is coming down quite a bit. You know, ConocoPhillips down 5, Cope 5, EOG 5. Besides that, everything else is kind of just mixed. You know, Amazon earning is coming up. Tesla already had earnings. We're pretty good, guys. Now, as far as crypto, this is having a little bit more of a weird response, and this is mostly because, again, remember when I was telling you guys my first big warning sign for you guys was what happens if Bitcoin breaks down below the 50 moving average on the 4-hour chart. Now, we saw weakness here. It came back up, but it got rejected off of the 20 moving average here, and that's not like a horrible thing. Right now, we're just dealing with a slight break in trend, and we're just coming down a little bit. I don't think this is anything to really worry about. Maybe if rate hikes are kind of unexpected or higher than expected, sure, we could have a little bit of a drop as far as Bitcoin's concerned. But until we break down below that support of 22,279 or about, I'm really not that worried about Bitcoin. We can go sideways, up and down, sure. What I'd be saying to you guys is, at this point, watch the altcoins. You see Ethereum over here down about 1%. What did we talk about the other day? It's just still trading within this trading range. Nothing really bad here. It's when Ethereum and Bitcoin start to break down below these ranges that you really are going to start to panic here. Or not panic, but start to get worried, maybe scale out a little bit more than you otherwise might have. You see stuff like Matic coming back down bit by bit, but that's because Matic and some of these other altcoins have already had their breakouts. They're just giving back some of those gains, right? If Matic was similar to Ethereum, it would still be over here consolidating, waiting for that breakout, waiting for Bitcoin and Ethereum to also have their breakouts. You see the same thing with Doge. Dogecoin, I did a video for you guys the other day, yesterday, I believe, talking about how this can hit 18 cents by the end of February. Again, we need all that good information, all that news, and that 18 cents is right up here. Oh, this is different. This one's at 23. This orange line's supposed to be down here. I must have did something wrong. Or I probably actually moved something. Yeah, I did something wrong. That's not a problem. Let's see. Let's see over here. All right. But even as far as Dogecoin's concerned, you guys know we had this breakout a while ago. Nice, easy breakout. But Dogecoin really hasn't been trading in a nice little sideways move. It's been going higher and higher and higher, making these levels of higher highs. Everything that's been making these levels of higher highs instead of just these consolidation patterns, they're giving up a lot of their gains over the past, let's just say, 15 to 20 hours or so. You got XRP over here, also had a breakout, nice little move, launched up, just giving back some of those gains. Link, same thing, looks kind of like Dogecoin. STMX looks like Dogecoin, had a nice little rally coming back down. Sheeb, how did Sheeb even do? Got rejected off of this longer term trend line here. I don't even think the trend line was too much. Let's go back over here very fast. There we go, yeah. So just got rejected off of this trend line. Nothing bad here, but definitely giving back some of those gains because, again, if you look at the past few days, it definitely did have a really nice breakout there. So everything is pretty much doing something similar. You see Ethereum, Litecoin's breaking out right now. A small breakout, but, it's still trying to hold it up. I would say just watch out for this with the 20-day moving average. When that crashes, this thing's probably going back down to $82 if it does crash, right? And, of course, yeah, you can see some of these moves. So, again, guys, I'm not really too concerned. I think we're still in a very good position as far as the market's concerned. You see right now Ethereum Classic is currently testing out some support levels, kind of a scary level to test right here for Ethereum Classic. But, if you went from here to here, this one worked out. This one worked out a little bit. This one, maybe it will, maybe not. It won't. If I'm looking at this 4-hour chart, look at this. I can see a cross in the future. That might mean that Ethereum Classic might be coming back down here to sub 20 levels, just like 1955 or so. That's what I'd be looking at as far as buying opportunity. I'm kind of more hesitant here. The one thing that could save it, again, is going to be these rate hikes and what happens tomorrow with earnings. Earnings are just going to be massive. And depending on which type of Fibonacci levels you guys are looking at, you can see we do have a level of support over there. I'm not really using this one all too much personally. I would just say use this larger one over here. There you go. We hit the one target level. That's usually where I sell. Normally, you guys can maybe go a little bit higher, but if you guys know me, I just like to make my money. I don't really care about making the fantastic gains. That's what my long-term holds are for in crypto. But you can see right here, hit, hit, hit. I'm fine with taking my money out there. And then if you just want to find some of a general pullback, there's two ways to do it as far as Ethereum Classic, because I know you guys like to trade this one a lot. You can see these ones didn't really hold up too much. It held up. I mean, a little bit of support, but you can see it just clearly dropped. I would be coming back down here again to somewhere between 1990 and 1870. I would choose that as a buying zone. But I would have to say be very careful if you guys are going to try to take some of those positions, because if Bitcoin, that would mean that Bitcoin is also breaking down. So if Bitcoin's breaking down after having a robust January, do you really just want to be trying to catch every single drop? Probably not. So just understand that, okay? You do want to see Bitcoin still holding strong while altcoins are going down, and that would give you maybe a little bit more of a optimism for actually buying into a play like this, okay? Now, the other opportunity you guys can do from here on out is just go from your other Fibonacci level from here to here and kind of hope for it to drop back down a little bit more. If you're kind of more pessimistic, you might just want to buy around here 1782, which matches up with this low that we have right here. That's kind of the ideal pivot point if the market does start to tank a little bit more, because by then this is going to be a pretty big drop. It'd be dropping about 15%. That kind of makes sense for an altcoin like Ethereum Classic, right? So, take your time with these types of moves. Now, let's see. And hey, Alex, market's going to be volatile. Yes, very much so. And yeah, Loki's chill, guys. He's very, very chill. He's over here between my legs just saying hi. No dump today. We got to go up, stay positive. I mean, guys, as far as we're concerned, we really should just try to me, rate hike is part of it. I think a lot of what we're going to be worried about is basically what does Jerome Powell do during his press conference. So right now, guys, I have CNBC loaded up and ready to go. Oh, that's an image. There we go. How do I do this? Oh, snap. I messed up. I had to restart my software. Okay, hold on a second, guys. Hold on a second. I should make sure I get this right. There we go. There we go. Okay, there's that. Okay, there we go. I got CNBC locked and loaded, ready to go. You can see that deodorant commercial right there. And once they start announcing the rate hikes, we'll go straight to CNBC. Then after that, we'll be watching Jerome Powell's press conference. It should last about a half an hour, and that starts about a half an hour after the rate hikes come out. So that's what we're going to be looking for right now. So, as crazy and wild as this market's been, it's okay if we kind of give back some of those gains. But again, let's put it in a little bit of perspective here. Let's go back over here. You zoom out a little bit. This is where we're at. We've had a really nice bounce. Let's zoom in a little bit more for you guys, because I forget you guys can't see everything my window sees. we've come down a lot. We definitely had a really big bounce. Um, we're getting close to some really heavy resistance here as far as the weekly charts are concerned, though. That's my big concern. Um, so we don't exactly know how strong these two are going to be because it's never happened before. Remember, guys, we've just never had those death crosses. That's what makes this whole big move here so interesting. And if the economy really does start to get more worse, and so to speak, you'll see some issues. Let's just say that as far as the price action for some of these plays. Um, I would love to see if Bitcoin could just try to stay above this level for the foreseeable future, kind of like right back down here around $18,000. If we can just stay above that, I'd be very, very happy with the market. I know we've always been looking at some of these Fibonacci levels and Gann boxes and stuff like that, but we've really soared above all these support levels here, right? What was support here? What was support here? We soared through it. Right now, we're just getting rejected off of this monthly moving average, it looks like, plus the Fibonacci level here. That's going to be a pain. But we could easily have another big month that takes us up to $26,000. But that would require us, again, to get to these moving averages, which seems like it's going to be a very hard thing for us to do. You can see right now we're just getting rejected off of this little trend line or angle, if you will. I'm not like the most concerned, but you can see that's like, at this point in time, that's really what we're kind of having some mess ups. You can see a timed Fibonacci level. Sure, that kind of signifies maybe a pivot here. I think the fundamentals of the market plus the earnings, that type of stuff, that's going to be more important than just the timing, potentially timed Fibonacci level here, right? Because this, it worked out a little bit here, but see, held up for a day, 3 days. Fourth day fell, but I guess exchanges were falling off of a cliff, and that's where all that broke down. Same with here, right? The only thing that really took us down below these really strong levels was just exchanges, massive exchanges going bankrupt or fraud, I guess, for FTX and Celsius, Voyager, 3 Arrows Capital, all that disaster stuff. But at least at this point, and this is three separate Gann boxes, everybody, so this is going to be clustered as can be. But we break out right here. We have an opportunity to go up to 24,899, close to 25,000. I think that's our next step if we have some good news coming out for the rest of the week. Okay. Now, a lot of you guys probably don't like this clustered look or so, but I would encourage you guys, if you guys ever want to do the Gann boxes, August of 2015, December of 2010, March of 2020, the COVID lows, they're really good opportunities here. And, while they're not perfect, they do give me some good insights as far as what happens when we kind of have these really parabolic moves and what happens when we have these really big drops. One of the reasons I scaled out so much around here is because this was a good level of resistance according to the Fibonacci, the Gann boxes basically. So if we go over here to the daily chart, you'll see why I was scaling out, because oh, look at this, boom, 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 right? And I even started scaling out down here at $17,000, $18,000, right? And so I'm pretty much out of my crypto positions as far as swing trade, spot trading. I didn't do any leverage trades on this. I do leverage with day trading. But I'm basically just waiting it out and seeing how this all works, because you can't just use this type of stuff. You also have to be just looking at your basic trend lines, right? Hey, a breakout. You can buy there and look at it go. Have a stop loss, of course, but that's the way I've been looking at it so far. So I'll be doing a couple more of these later on. You can even see this basic one here. This one goes all the way back to how far away does this one go back to? 2011. This isn't right. What's going on with this one? Maybe it is right. Lock the ratio. Oh, I have to lock the ratio in order to see everything. Oh, that's a pain in the butt. Okay. I haven't been on this one in a while, so let me scale this over here. Let me stretch this out. If I stretch it out, maybe it'll look a little... Well, we don't have to wait. Yeah, the data's not going to be... it's fine. It's good enough. But you can see over here, it worked out perfectly. We rode this one down. A little bit of resistance here after FTX really screwed everything up. We'll clear up here to 27,000 up on this one. I doubt we're going to get that high with the way the economy is going. See, that worked out. That worked out. That worked out right there. Yeah. That 2000, it's crazy how you can go back in time so far and see some of these things still actually having some effects. Even over here when we broke out, you see that support level over there, resistance level over there, and you could have technically made this back in 2011, but come on, guys, like who knew that Bitcoin was going to be going up so high? I sure didn't. Otherwise, I would have bought more. But yeah, so far, we're looking pretty strong, everybody. Don't be afraid if we do come back down to the $20,000 level, like $3,000 loss over the next few weeks. But that's only going to happen if we have some bad data out there. or negative data. I would just say not bad. It's just going to be data. Let's see. Oh, Biden's competition council is meeting to discuss capping credit card fees. That'll be interesting. I'd want them to actually cap banking fees, because all I've noticed as of late, as my bank is just finding ways to charge me for stuff like I don't even use, or I've just heard stories of it on TikTok as well. I think I just pay like $20 a month for my debit card. Like I pay for my debit card every month. Actually, I'm not entirely sure if I pay. I think there's a fee, but I think I use my card more than enough, so maybe I don't have to pay it. But I know when I signed up, they actually asked me to do that. We've broken down here, showed some weakness. Now we're going to some higher lows. No, not higher lows anymore. Yeah. There you go. But if anybody has any questions on any potential coins out there, let me know, everybody. Hey, Inferno, no worries, guys. Yeah, I mean, the way I always work is I'm a very simple trader. I'm self-taught. I think the way you make money in the market is basically very easy process. You learn everything you need to know about trading, as far as what technical analysis is, what are indicators, what's basic stuff, right? And then I start learning about patterns, breakouts, double tops, double bottoms, stuff like that. Buy the breakout, whatever, moving averages. You kind of pull all that stuff together, divergences, blah blah blah. But then I think the key here for me is just doing your getting a trading journal, recording every single one of your trades, keeping track of everything, and see what you're good at trading, like what stocks and assets you're good at trading, and then what patterns you're really good at trading on those specific assets, and just stick to those. Your goal is to get like a 70% or higher profit rate. So if you're making money 70% of the time, you're good, because usually those profits outweigh any of the small losses you're going to have because of those stop losses, right? But being safe and smart about how you invest. But at this point, like I told this to the members on Sunday, and I told this to everybody else on Monday, I believe. Right now, the technicals don't really mean as much. Like, they're there. You can think of like some really high levels and some little bit lower levels, like like up 5%, down 5%. But the technicals aren't going to really matter all too much, because everybody is trading off of the news. And if everybody's trading off the news, that's going to make things a lot more difficult as we try to figure out exactly where we're going. That's why I always try to pull out some of these larger technical analysis, larger time frames, and I try to pull out all this other stuff because, it's there. Like, you can see the resistance clearly there. There are other ways to look at this resistance level. Like, you could have put up other levels of Fibonacci, but when you have this kind of stuff just set out, you don't have to look at it all the time, but you can see, hey, there's going to be some resistance here, maybe some resistance here. There was no resistance there, which is kind of interesting because Bitcoin just popped up. Maybe if I go over here to the 15, there might be something, but I don't think so. It just kind of went parabolic. Yeah, see, there's resistance, but I mean, for like a half an hour, the 15-minute candle here, 15 minutes here, then pop. So you can see how every single one of these lines has a meaning, but it's not like you should just sell out them. I usually scale out. Whoa, what was that? Oh, what was that again? Am I messing up something? Okay, hope not. But yeah. I have a video about GAN boxes if you guys want to watch it, but it's like, I don't know, 15 minutes long or something like that. No, actually, I think it's only like 7 or 8 minutes long. 7 minutes long. But yeah. So everything matters. If we just consolidate for a few weeks and then we pop breakout, I'd be happy with that. My big concern, though, is basically you got some resistance here, and you got some resistance with those moving averages. As soon as we can figure that out, whether it's good news or bad news, whatever, I'll be very happy to see how much further crypto can go over the next few weeks. February should be a fun month at least. All right, there you go. Because again, this is the daily chart. We're still consolidating. We're not in a bad spot, and I'm okay with that at this point. Yeah, we can go for the second ticker. Oh, this isn't the right chart for the second ticker. We need to go to the Binance one. There we go. Second by second. All right, there we go. And hey, Bideford, happy to see you. I'm at work. Thoughts on Doge? You see it keeping pumping? I would say Dogecoin only continues to have this longer term pump if we have good earnings tomorrow and like a 25 basis point today. So today we have earnings as far as Meta is concerned. That's going to be very, very important because it shows like where ad revenue is going. Basically online spending. After that, tomorrow, though, Google also does earnings, and that's another advertising giant. YouTube is owned by Google, if you guys didn't know, and basically they'll also have, they'll be talking about their own advertising dollars. If Microsoft has bad earnings, say, with advertising, that should affect Google tomorrow. But I think if Facebook today has good earnings with advertising, you should see that be good with, that should give Google a boost tomorrow. So basically, you can kind of get at least one of those three earnings out of tomorrow, kind of out of the way if we have good earnings Meta today. Now, going for tomorrow as well, we also have Apple and we have Amazon. I honestly don't know how the earnings going to be. Apple is usually pretty stalwart with their earnings. They're usually pretty good. If we go check out Apple, I guess right here for now, let's just go to Apple there. Let me pull this up on the right-hand side. Can I just show you guys this? Can I pull it out or something? No? Okay. You can basically see even though earnings have been going down, they've rebounded last quarter, and it's estimated to be kind of up here. Let's hope it's okay. Q1 last year they beat, Q2 last year they beat, Q3 last year they beat, Q3 last year they beat barely, and hopefully Q1 this year they'll beat again. So last 4 quarters they've beaten. So I'm hoping that they beat this time, right? And as far as, let's go back down here. As far as Google is concerned, oh no, we're talking about Amazon. Yeah, there you go. As far as Amazon's concerned, let's go over here. This one's been more chaotic. So they beat by a lot in Q4 2021. They dropped by a lot in Q1 2022. Q2 last year, they were below earnings. Q3 last year, they were above earnings. And now Q4 of last year, we'll have to see how that works out. But they've been a little bit more oopsie daisy. And if I were to be honest about Amazon, well, not honest, but like you know what I mean, like just tell you my feelings about it. I've seen a lot of TikToks of like Amazon warehouse workers just not having any work to do, and I've heard stories of just like fulfillment centers that were built that aren't even being used because they just don't have the capacity right now. Like there's not enough people purchasing stuff off of Amazon to do that. And I think what happened with Amazon is, this is just more of a theory of mine, is during the pandemic, they thought we were going to be under lockdowns for a lot longer period of time. If you guys remember, even going back to the beginning of Joe Biden's administration, they tried to keep lockdowns and keep people inside a little bit longer than like people kind of wanted to do. So there was more protest, and eventually, once like they saw the election was coming up, they kind of all were like, okay, we just need to let people go out, no more passport things when it comes to COVID and stuff like that. I think Amazon was banking on the government locking down people for a lot longer period of time because, people are still dying of COVID. They're still dying of all this stuff, but people just kind of had this acceptance of like, okay, I have a risk, but the risk is so small, and that's what the science says, so I'm just going to go back out and live my best life, right? Nobody wants to be scared living in their apartment. It's a miserable way to live. I remember during COVID, I was freaking terrified. Kind of. I was doing Uber for fun at that point in time because I was so bored and I needed a legal way to get out of my house. So I'd sign up for Uber. Luckily, I still had a car that was, eligible. But, so I think they built up all this infrastructure to support that type of environment. And I think that environment no longer exists because we've opened back up. I don't know about you guys. I still buy stuff off of Amazon. But, I go to Home Depot now if I want to buy something important. I don't just go to Amazon automatically. I go to the store to buy this. I go to the store now. I don't go to the store to buy groceries that much, but, because I get Instacart. But, I'll go out and I'll go buy stuff. And I think that change in the market has really hurt them bad. And you've even started to hear stories of FedEx starting to do layoffs and starting to cut pay for certain executives. It's going to be a hassle going forward, everybody. I mean, like, let me go to CNBC. There has to be... White House likely to tap Bernard Bernstein as top economic advisor. We'll look at that in a second here. Yeah, there it is. FedEx is laying off 10% of its officers and directors amid cooling demand, right? So they already know cooling. But they had a really good earnings report last quarter, I believe. Well, let me just go over here to FinViz. Let's see, what's the... Yeah, it's up 3% today off the news. Let's go over here very fast, right? They've been chugging up just fine because, of course, GDP growth has still been doing okay. Slowing, but still doing okay. So, again, we go down here. All you see is downgrades. Kind of makes sense if you think about it. But again, it's downgrading and it's still going up. Shows you with the market just kind of buying up a whole bunch of stuff. Where's the earnings here? Oh, there we go. Okay. Let's see, total revenue. Yeah, it was fine. It went up year to year. It went up even after everything that we've kind of been through with inflation. Everything went up, up, selling up. Let's see, operating expenses went up, operating income went up. Let's see, interest income went down a little bit. Let's see, the loss went down a little bit, so that's good. Net income before taxes, that went down a little bit. Provision for income taxes, that went down a little bit. Net income, that went down a little bit. So the profit went up, but the income went down. Oh, that's actually pretty interesting. Let me go over here very fast. FDX. Pull up the handy dandy. Yeah, so last quarter they beat. Q1 of 2022 they did not beat. Q3, where's Q4? Oh, I guess they just haven't updated it yet. Probably another earnings probably aren't for a couple more weeks or something. But yeah, so drop that back down. There we go. There's some, to me, there's some signs that Amazon's not going to be as strong as we want it to. I think Apple may be okay. I think that Google may have some issues, but we kind of want to have all three be good, because if they're not, that's again where we start to we're teetering a little bit, and that can cause some chaos. So the new economic advisor, this must be Bernard. Let's see. The White House will likely appoint Federal Reserve Vice Chair Lael Brainard to run National Economic Council and Jared Bernstein to lead the Council of Economic Advisors. Sources familiar with the matter tell CNBC. Let's see. So they're going to try to tame the high cost of living across the country. They can't do that. In order to fix some of these high costs, you really have to understand the way the market works. And you have to understand how these corporations work. You would actually have to get the corporations to come to the table and say, hey, this is what we need. This is what we have to do in order to get the prices down. Usually governments don't like to do that because the corporations will be asking for a little extra than what they need, right? And so I don't think you're going to see much progress on that front. I think you'll just see naturally inflation slow down, but costs remain high. Because I've been looking around here, around where I live. Sure, housing prices have come down a little bit, but it's not like they've fallen off a cliff. And then when you look at apartment costs are still as expensive as ever. They haven't even tried to lower the price of apartments. Like, the apartment complexes out here are perfectly fine having 50% vacancies in their apartments if they can keep everybody else paying the $3,000, $4,000 a month for rent. There's just no reason to lower the prices at this point. Let's see. And hey, Prince, how do you do day trading with Binance? I would refer you to just a simple tutorial. I don't have Binance open on my computer right now, and I don't want to log in. Binance is fairly simple. It's kind of similar to the BitGets, the KuCoins. They all kind of use a similar trading system here. I would say at the beginning, I would only recommend that you would probably do spot trading. Futures trading and doing leverage can be very, very, you can lose a lot of money very fast just by practicing. So I would say that you should watch a few YouTube videos on how to use Binance from beginning to end. Understand how everything's kind of labeled out, because a lot of these exchanges have a lot of different tools, a lot of different tabs that go over a whole bunch of different stuff. But as far as day trading, I would probably say stick to spot trading for now. And then if you wanted to go do day trading with leverage, do that once you kind of have a good system set up for yourself so you understand everything about Binance, because it's not too hard to actually learn how to use. But if you don't know how to use it, you really want to practice before you even start injecting money into that, because you will just lose so much money doing futures trading and stuff of that nature. And hey, Mr. Joker, happy to see you back. Let's see. Hey, Mando, can I look at INJ? What is INJ? Let's see. Let's go to the daily chart here. Well, this one's been doing fine. It's been pumping. It managed to break out above the old resistance level up here. Just did that yesterday, it looks like. And you can see actually retested today. The support come back down. Yeah, it came back down a little bit. All right. So, before we get started on some other stuff here, we got 8 minutes before rate hikes come out. What a nice little downtrend here. I would only touch this as far as buying if we did a breakout from there. Now, as far as what I see from here, though, let me take this apart now. Let's go over to the daily chart. How big of a move has this been? Because this seems pretty high. Yeah, there's our resistance level right there. Had some up there as well. So if you do see that breakout, then we do have some more good news as far as Bitcoin and other assets are concerned. I could see this getting it back up here towards 381 or so. After that, I mean, let's kind of check it out very fast. What do we have to deal with before then? There we go. That matches up with that Fibonacci level actually we were just talking about, so that works out. Uh, you know, even though this thing has gone up a lot, I don't probably. Actually, let me before I say something. Let me just go over here to Coinbase or Coin Market Cap. I need to figure out what the market cap of this coin actually is. INJ. Market cap of 235 million. Okay, this thing can actually pump up a little bit higher here. So, maybe at the high it gets up here to 546 or so. That's maybe a possibility. I would say I'd probably just scale it here on the 530s level, right up here towards this former peak, if you guys can see that. So if you wanted to buy a breakout after having very good news, right, and it keeps on chugging up, this whole lot would be where I would be looking to sell my positions. I would probably sell 30% in this first small block and see what happens up here if it does make it that far. If it comes up here and it starts to fall back down, stop loss would probably be right around there, and I would just take my profits and run, because even if you buy here and sell here, you're still walking away with like 20% profit. Take it, leave it, go on, And if you already have a position in this, I would say at this point, I would just have a stop loss here at 261. Let it ride off a little bit longer. You can always try to move that stop loss up if you want to. Sometimes people don't want to go for this previous low, like right there. They may actually instead just say, hey, I want to go right up here and see what I can find. Until you kind of have a relative high, though, it's going to be very hard to really get a good support level for this one, because we already had a nice little breakout. If you want to have, a shorter term stop loss, you could always use that support level we talked about at the beginning of this analysis right there. But when it came down to retest right here, you could use that $3 range. That's not too bad. This one, if you want to have a tighter stop loss, it's like a 5% stop loss, probably more reasonable. And by then, if it does come back down here, there's going to be some death crosses. We're going to have some nasty moves, right? So, not a bad thought right there. If you're thinking more long term, like you think we might have a big move over the next couple of weeks, then you could wait for it to come back down here. But it depends on how much skin you want to have in the game as far as that one's concerned. There you go. All right. Now, I'll probably put the minute chart on when the rates come out so we can kind of see what's happening. You can see Bitcoin's trying to do a small, teeny breakout here, right? Let's see how high it goes. But it's just some small stuff right now. Bitcoin's not really too volatile. And hey, Justin, Powell has not spoken yet. We have rate hikes coming out in 5 minutes, and Powell will speak a half an hour after that. We also have the dollar index here getting prepared for this big move as well. So you can see it starting to pump up a little bit too. So 2 hour, it's been coming down. It's just going to have a little bit of a pump after we do the rate hike. After that, probably come back down, honestly, as Jerome Powell talks. All right, there you go. See, nice little simple breakout. I feel like Bob Ross when I'm talking about breakouts. Oh, look at that little breakout pop up right there. Oh, look at that beauty. Let's see. And hey, Shane, FOMC meeting. The rate hike comes out in 5 minutes, 4 minutes now, and we have the meeting with Jerome Powell coming out half an hour after that. 11:30 my time. I think it's like 2:30 Eastern time. Let's see. And hey, Jonathan, any news on Roblox? I haven't heard much about it. I know some congressmen and women were selling some off. I think Nancy Pelosi's husband sold off a bunch of Roblox. Nancy Pelosi's husband's been selling freaking everything. And hey, Nash, you got some Solana. Nice. Could be next Solana. XRP. What do you think about Carvana? I think Carvana is probably going to go bankrupt if the economy really does go down. I've heard so many problems about them, and I feel like they're just getting more and more lawsuits now, like at small claims court. Like people getting cars that don't have the right tires. Like imagine getting a new car, but it doesn't have the right tires. I've been hearing weird stories about that. They've been taking the tires and doing other stuff with them, like putting them on other cars, the used cars stuff. It just feels weird. I'm more concerned about Carvana, I would say, but I'm not really the most excited about it. And you can see Bitcoin taking a little bit of a drop now after that little breakout. Probably, oh yeah, we just hit a resistance level right up there. I mean, I don't even know what Carvana's ticker is. Carvana. It's had a rebound since the bottoming of the market back when it was $3.63. It's bounced up a little bit more. The income, it's still losing money. Oh, this is not it. This is not it. Carvana. About to say that's not it because that's a bank. Car Therapeutics, cars.com. Maybe I don't know how to spell Carvana. I don't actually ever look up Carvana. Carvana. Stock. Let me just find the ticker here for you. Oh, it's just CO? Oh, CVNA. Oh, yeah. Okay, that makes sense. CVNA. And we got 2 minutes left, so I'm going to make this fast. There we go. It's come back up to $11, and it used to be kind of around $3.55. That's why I got the $3.55 in my head. But yeah, it's still, I mean, can you guys see this? See how much money that sucker's losing? It only has a $1 billion valuation, but it's losing so much money. And look at the sales. Only $15 per $15 billion for a quarter. Yeah, that's not gonna sustain itself for very long, everybody. You need something better than that. You really do. Look at that. Look at that short float, 58%, 58%. Everybody like from neutral to underperform, $9 to $1, $50 to $5. Nobody expects this company to do well. Nobody. This is going to be a short squeeze candidate for sure. I mean, you can see how many people have been like buying this up last year. Look at, they bought this in March. They bought $2 million worth, $269 million worth. Now they bought this at $80, and they bought 3 batches of it. So they spent Fed decision imminent. Okay, let's go over to the Fed decision. But I mean, imagine spending close to like $400 million at $80. And now the price is at 11. Talk about a shitty investment, okay? Oh my gosh, okay, here we go. So we're good to go.
Above 5%, which would imply another hike in May. And I really think it's the question of how much they want to push back against the rate cut bets in the back half of this year.
Okay, I'll wait for the come news, but I think you guys will be able to hear it oh, there we go. There we go.
Against cuts.
Jim?
There's a lag here, so you guys will get it in a few seconds
after I do. The Fed has a very difficult job today. In one sense, they have to decide that they're slowing the pace of rate hikes to 25 basis points. On the other hand, they don't want to let people think that the terminal rate is already baked into the cake and that they need to keep that an open, hotly debated question that they're thinking about. That way,
some volatility, a double top forming. Hopefully, we can break out above it.
So look, I think they go 25 today. They probably do another 25 in March. That will, in my view, that's probably where they end the cycle. But overall, the key message for them.
What are you guys thinking about votes? So most of you guys say 25 basis points, 31% say 50 basis points, and 6% say greater than 50 basis points, and 10% say 0 basis points hike today.
Is have inflation not.
Okay, I'm just gonna wait because this is boring talk. I just want to see the decision here because we're seeing these little boobs. I haven't seen anything really drastic. I mean, this is somewhat drastic, but not like totally drastic. There we go here. That's right here. So we're seeing some nice moves, but again, nothing too crazy. Look at the 5-minute chart. We've had a little bit of a dip. We talked about that breakout a few seconds ago. This breakout, though, got messed up. There we go. Let's go back to the second chart. There we go. This might be it. Once we can find the Fed decision, though. Let's see. Hey, Kevin, announced up to 35 basis points? 35? Oh, okay, 25. Oh, okay, I was like 35 basis points. What a freaking weird number to toss out there from the Fed. That would probably freak out everybody. You can see the market's not taking it too badly. I mean, yeah, 25 is within expectations. It seems like that's what's going on. You can see the market, Bitcoin's positive for the day. Mostly everything else is still negative. But so far, it looks like we're doing okay. So in a few seconds, you'll hear more about it on CNBC. Let's see. And hey, Jane, thanks for letting everybody know. Hey, Crypto Indie, Rocket Ship. This is a pretty nice move that we're watching right now. I like to see stuff like this. Although I hate the lag time when it comes to CNBC. Oh my gosh, online viewing is so much different than actually watching it at home on the TV. But you're still seeing these nice little moves up here ever since the news came out. A little bit of a dip. Now we're going back up a little bit higher. Little double top here, right? There we go. This is just fun little mini day trading. There we go. Oh my gosh.
With the Fed's decision. Federal Reserve raising by 25 basis points to a new range of 4.5 to 4.75. This is the 8th straight hike by the Federal Reserve since March, up by a quarter to 4.5 to 4.75. The Federal Reserve sees ongoing increases as appropriate. So that phrase that some thought might come out remains in. The Fed is still en route to a level it calls a sufficiently restrictive level of the funds rate. One little bit of dovish commentary here says inflation has eased somewhat. However, it says it still remains elevated. The Fed is signaling a new focus on the extent of rate increases and not necessarily the pace. So it says in determining what it now says is the extent of increases. That word had been pace previously. So it's not thinking about it going up by 25. It's thinking about how far it goes at this point. On the economy, it sees modest growth in spending and production. It says job gains have been robust. The unemployment rate is low. All language from the prior statement. The decision was unanimous with the 4 new voters replacing the prior 4 who were out there. So, Kelly, back to you. Up a quarter. Still thinking about ongoing increases, still heading to a sufficiently restrictive level.
Any dissent, Steve? That's a pretty big deal that they left in the word ongoing. Wow.
Yeah, they left in ongoing means they have more to go. I guess that's pretty clear. And they're not backing off anyway, this idea of going to what they call a sufficiently restrictive level, which tells you that they don't feel like they're there yet.
Right. And as we can imagine, Steve, thank you. We'll come back to you in just a moment. Markets are reacting about as poorly as you might expect, although we were all saying all week long we're probably bracing for
Bitcoin is kind of like Bitcoin's not even doing poorly on this.
Yields perking up a bit. Let's bring back our panel along with Bob Bassani and Rick.
What do you call it? It's not even doing bad at this point. We'll keep watching it. We can listen to CNBC for a few seconds though.
You know, we do see 2-year notes spike, but they're already coming back down. We saw 10 spike. They're coming back down.
Spike, come back down.
Dow Jones Industrial Average drop, but it's coming back. There's a lot of mean reversion going on there. Listen, after listening to Steve's highlights of what the Fed has in the statement, it seems to me that the guardians of the U.S. economy, which is the Federal Reserve, aren't going to be happy till they give birth to a recession. We've seen economic contractions like PMIs, and I see sections of the economy slowing, but we have a strong labor market, and labor is a pain that the Fed doesn't want to occur. They want to induce weak labor pains, and to do that, they're going to keep higher for longer. So no matter how you slice this, I do believe that the markets are going to continue to look beyond the rhetoric, look beyond trying to give birth to a recession and the cleansing breath it may need for pricing after we've gone through COVID and all those issues. But in the end, it certainly seems to me like all the momentum in pricing has reversed, and the only thing left is for the Fed not to blink too early, because there is no good reason in their minds, in my opinion, that they should ease back. They should keep rates up. But I certainly don't believe that there's going to be a March increase. My personal feeling is that this is going to be it for now.
I don't know. They just said ongoing rate increases will still be. By the way, the Dow's down about 400 points right now. David Kelly,
Okay. So let's kind of talk about that. You said the dollar index have a spike here. The Dow is giving back some of the gains from earlier today, but it's still managing to have a little bit of reversal here. So I don't think the market actually understands how to digest this news. But let me know what you guys think in the comments, because I'm curious. Because it seems like everybody's getting stuck on that word, ongoing rate hikes. So that means that we might actually have another rate hike here. People were assuming that this might be the last one. Maybe it's not going to be. And you heard Steve on CNBC going over here and talking about this. He's like, the Fed will not be happy until they give birth to a recession. So, perhaps they want the job market to finally break, and that will cause inflation to cool by enough. Inflation is going down, but it's still going to be sticky. It seems, we've talked about this a few times here, but let's kind of elaborate on it a little bit more. And let's go over here to Bitcoin. Kind of go. You can see Bitcoin chart spiked, came down, spiked up, came back down. Interesting look, of course. I can stress this out a little bit more as well. Definitely kind of an interesting move here. But what's been going on at this point is there's like 3 prevailing winds of what's going to happen this year as far as the economy is concerned. Okay, the very, very dovish set of people, the ones that are kind of driving this rally that we're seeing right now, are saying this: the bottom is in. We're not going to have any new lows for the year of 2023, okay? We're not going to break down below those October lows of last year. Their mindset here is, okay, Inflation is cooling, which is correct. Earnings have been okay, which is, yeah, good, correct. They've been okay. Not great, but just okay. And the labor market is strong. And the labor market has been very, very strong up to this point. And they're saying that what's going to happen here is inflation is going to continue to go down. And the economy will start to dip down a little bit. We'll get a little scared here. But then what's going to happen is the Fed is going to see this and they're going to blink and say, hey, we're not going to raise any more interest rates. In fact, we're going to start to cut rates. That's the bullish thesis pretty much for this year, okay? That's what the bulls are really hoping for. Me, on the other hand, I'm kind of in this mid-tier where I'm like, hey, I think a lot of this stuff, what they just said, is true, but I think things are going to tip over and we're going to go into a recession. But I don't believe that the Federal Reserve is going to blink and start to cut rates. I think instead they may stop rates, they may stop raising rates, but they're not going to cut rates. And I think because of that, the recession will go a little bit deeper. It'll be painful, but it won't be 2008 bad. It won't be 2000 bad. It'll just be a bad recession, okay? Where you can see Apple going down to like $100 max, okay? Now, the really bearish, pessimistic view is that there's no rate hike cuts, but the recession gets much, much worse. Where there's some type of global system failure. I think this is like more of like the Great Reset talk that you guys hear all over the internet, where the economy gets so bad, we kind of messed this up so much that people, like so many people lose their jobs. There's no way to fix the system in a short amount of time. People get really, really mad, upset, and the unemployment rate like goes above 8, 9, 10%, which I don't think is feasibly going to happen. But if that were to happen, you could see Apple like at $80, at $60, stuff like that, where things are just quite catastrophically bad. I'm in that middle tier here, and at least at this point, the fact that they're even saying that we might have to hike rates again, to me, that makes me believe that, hey, I think we're probably going to go to that middle tier recession level, which isn't bad. It just means that a lot of the assets that we're all looking at, we're probably going to have another opportunity to buy them at some low levels. I don't exactly know what this means for Bitcoin because most of the time, as far as Bitcoin's concerned, we can look at all these Fibonacci levels and GAN boxes and stuff. The technicals have been so screwed up because of what's been going on as far as how do I say this? The FTX crash, Celsius crash, they kind of just break through the technicals and we just have to find that next level. The next level for Bitcoin really is around $14,000. But I don't see us going to $14,000 for months and months and months, hopefully, unless there's some type of really nasty economic data that just flips on a dime, But I don't think we're going to see that until spring, Q2. We're still in the middle of Q1, right? My personal opinion is Q2 is really going to be when things start to get bad. Q3 is where everybody starts to feel the pain. But somewhere in Q2, Q3, I really expect the market to have a bottom there, and that's why I'm really hoping to kind of spend the majority of my my cash on a lot of these assets like Bitcoin, Ethereum, Dogecoin, STMX, SHIB, whatever. Those type of moves. Let's see. Yeah, and guys, we have about 20 minutes left until Jerome Powell speaks. You guys can see right here on the right-hand side, you got CNBC over there. They're not talking about much. They're just continuing to talk about the rate hikes. Right now, we're sitting at 450 to 475 as far as the Fed funds rate at this point. Not too bad, guys. It's not too bad at all. The big thing here is to understand we had 25. That's good news. Okay, that's fine. That's good. That's about as good as we could have expected today to go. Now, it's that keyword, ongoing rate hikes. So I think the market was pricing in this being the last rate hike, but the Fed is at least, I would say at minimum, keeping the door open to having rates go up in the future. And so if that's the key, if that's really going to happen, the market's not pricing that in. Remember, guys, we just talked about those 3 different ways that those 3 theses basically, or theories. One where the Fed blinks, they cut rates. One where the Fed doesn't blink and they don't cut rates, the recession kind of goes deeper. And one where the Fed doesn't blink, but the economy just goes to hell really fast. Well, that first thesis here, as far as the Fed cutting, that's what you're seeing. That's what you're seeing play out. Look at the Dow. Look at the weekly chart. Look at this. The Dow is only 9% away from all-time highs. That's that thesis working itself out over the last few weeks, months, right? Going back over here, sure, the Nasdaq's down more, SPY is down more, but that thesis that the Fed is going to blink, that is what's playing out in the market right now. This is why I was so confused last year when we were having all these crazy rallies, because personally, I just don't see that the Fed is going to blink. I don't see it. And because of that, I'm just more concerned that overall we're going to have this breakdown. We'll come back down here. we probably might just come back down to the COVID lows over here at 390 or something like that. Maybe down here to 320 if things get a little bit more pessimistic. But I don't see us just breaking out and going to all-time highs from here like, we back did over here in 2016, 2018, where we kind of had this nasty move. It came down, then we kind of soared back up. This was like an algo trading era on all of platforms, I think, too. But, but at least as far as this point's concerned, we're still above the breakout point on both these charts. We're still above the 50-week moving average. What has to happen now after all this is we have to listen to Jerome Powell's speech that comes up in around 17 minutes. And then from there, we also have to pay attention to the earnings tomorrow. I've been not screaming, but harking on this for a while now. When Google comes out, when Amazon comes out, when Apple comes out, that's really going to control the narrative for the next few weeks. And it'll be very good or very bad. And I'm hoping it's very, very good news. But now you guys could, if you guys watched the CNBC part a few seconds ago, you heard them just talking about the ongoing rates. Oh my gosh. Well, that's going to be the narrative over the next few months here until we have the March rate hikes, unless somebody asks a question to Jerome Powell during this press conference and he clarifies what he means. But I feel like if they ask him to clarify what he means, he's going to say, yeah, we may have more rate hikes. And that may piss off the market or, cause it to, scream and bash even more here. Through summer is what I heard weeks ago. He wants people to stop spending. Everyone is paying high food prices, but what choice do they have? People continue to spend because they continue to have jobs and they continue to have money. I just don't see how people can not be spending. Like, I don't know. Like, I naturally don't spend too much, but like, I just switch up my habits if things get kind of pricey. Like for example, like normally for me, I don't actually go to grocery stores. I haven't been to a grocery store. Well, up until yesterday, I haven't been to a grocery store in like 6-7 months. Okay. Normally, the only grocery store, if I do go to one, is an Asian store that has a duck that I like. Or I got a couple ducks in my freezer. That's only because there's no delivery. But I went to like a normal grocery store for the first time in like 6 months, and it was so interesting. Everything was so different. I went there because I was treating my mom and sister to homemade pizza last night. Okay, so we made homemade pizza, freaking amazing. But what did I do when I walked in there? I got a prescription from the pharmacy. I walked to the back. Me and my sister I got my sister some potato bread for her school lunches or something like that. My mom wanted to get for her. I went to go get spaghetti sauce, and I looked at spaghetti sauce, and there was like 2 sauces. There was something called like Signature Select, what I think is the brand name of it or something like that, and which was like 2 for $4. Or there was another jar of spaghetti sauce that cost $9. Like, I make over $100,000 a year. And I was still, 2 for $4 or 1 for $8. Let's go with the 2 for $4 store brand. And you know what I did? It tasted perfectly fine. It was some triple cheese thing. I put my own homemade seasonings into it to make it even better and make it more pizza-y, right? People are going to spend whatever they have to, but I think people just aren't going for those crazy prices. Like $8.99 for a jar of pasta. Are you freaking kidding me? Like, I will go to the store and I'll buy a whole bunch of clams, a whole bunch of mussels, but I have to value it, And I think people's values are kind of messed up right now because I have friends who make half the money I do, but still spend more money every month than I do. Like last month, I probably spent with rent, food, going out, probably like $1,500. Not that much, okay? I have friends that make less money than me, living in more expensive apartments, going out way more than I do, going out and drink way more than I do. And like, basically they're just not saving any money. All that money that they should be saving is getting pushed into the economy. And can you blame them after what we saw with COVID? So there's so much going on here. And I understand how, like what Jerome Powell is trying to do, but he's not going to be able to change that so easily. The only way he can really change it is to get you fired. And make sure, you don't even have money to go do it. I have a friend who was laid off. And that person, they can't hardly do anything at this point. I think perhaps she can go on free dates because she's a girl and get free food. That's it. Right? So, because even after she got laid off, she got put on unemployment, her expenses are still more than unemployment pays her. So, that's the only way I see it happening. And even now, she's still putting everything on credit card debt because she's spending more and more and more. Like, for me, if I ever got laid off and I was needing money, you know what I would do? I would unsubscribe from my Netflix, my Hulu, my HBO Max, my Disney Plus, my Apple One, TradingView, all I have like 1,000 subscriptions, but I would subscribe from all of them. I would try to make it so the only thing being taken out of my account balance would be bills, like for rent, electricity, and then food and gas. That's it. People don't know how to manage the money, and it's becoming more and more apparent. And remember, guys, I hate to say this, but our education system, as far as managing money and actually like saving money, spending this, it's just trash. The Powell's news conference starts in 15 minutes. But guys, like, I went to private school growing up on a scholarship because honestly, right, my folks didn't have much money, and the tuition was like $28,000 a year. It's freaking ludicrous, right? But they taught me in private school how to manage money, how I should be putting stuff in a savings account. Like, there was stuff on this. But, my best friend that went to Curtis High School, another one that went to Lincoln High School over in Tacoma, they had no education whatsoever as far as learning how to manage money. Like, the school even paid for us to go on a field trip to a place that specifically taught kids how to spend money. We actually had to draw cards out of like a hat type of scenario, and we had a job, and we were able to, with that salary, we were able to pick an apartment, pick a car, pick a lifestyle, pick a vacation, like that, right? So, and then we kind of had 3 jobs throughout the whole day, so you can have like a poor job, a medium class job, and a upper class job. Well, no matter what job people chose, they totally spent all of their money. Nobody managed to save. Everybody was like, no, we just want to get that new car, that new boat. We had to be trained out of that, but most people aren't trained. One of the things that I always realized, because I grew up in the ghetto, is, all my neighbors were either black or Asian or Eastern European. Like, this was like straight up ghetto, like rats in the houses before you move in. So you had to actually go to Home Depot, buy a block of wood and like fill up the holes. Like, not a good idea. Not a good living situation, right? Thank God I'm out of there. The houses have actually been torn down by the city because there's a black stain on the history of Tacoma. But anyway, when you think about, what the people around me were doing, they were on welfare. Some had jobs, but of course, back in the 90s, right, they're only making like maybe $10 an hour at max. And so they probably only have like a few $100s of disposable income every month. So they would buy the nicest, newest TVs, a nice new car, but they wouldn't be saving to even get out of their current situation, like that current living situation. Does that make sense? You can expand upon that to like the majority of Americans. They don't really understand how to save. And even the ones that do, they want to go out and live their best life after being told to like hunker down for 2 years during COVID. People are like, COVID, like being locked down messed with a lot of people's minds. You guys understand? Like, I completely went stir crazy when COVID happened. That's one of the reasons I got Loki. Like, I had a beautiful apartment, massive apartment with views of the water, and I still was not a fan of just being in the apartment all day. So this was in a downtown area, so I can just go out and do stuff. But they were like, you can't leave. If you got to have a mask, you got to have your shots and all that type of stuff. And I was like, oh goddamn, I'm just not going out. So until people change that, Jerome Powell is going to have some issues with inflation. But I think what's going to eventually happen is time is just going to fix it. Time, like a year. He may keep rates up for at least 6 months, maybe 7, 8, 9, like until the end of 2023. Maybe 2024 is when he finally starts to cut rates. And that matches up with the Bitcoin cycle of going parabolic. So I think that's going to be a really good thing for us. But I still think that this year in total is going to be where we want to start buying up heavily. So last year we bought up a lot. This year I feel like we're going to buy up even more. But next year I think is when all that kind of this work really comes to fruition, right? That's my personal thoughts. I just don't see it working out the way the bulls think, where we're just so that Jerome Powell just blinks like that. I'm like, oh yeah, it's okay if we don't get to 2% inflation, because we saw what happened with the last time Jerome Powell, a federal speaker cut rates too early. We had to raise rates again and cause another recession. He doesn't want to do that. After he lost so much credibility after saying a recession is inflationary, I think he's just going to try to keep his word. At this point in time. Let's see right here. Powell's not speaking yet, but he should be speaking here fairly soon. And hey, Tess, you're crazy. Save money for what? A life, have fun. You can't take your money when you die. Hey, Tess. No. I'm not talking about just not spending money at all. I mean, if you guys want to have fun, go for it. I don't care about that. I'm talking about when you literally like have no savings because you're spending all of that money out and about. Like I'm a proponent of like saving 20% of every check. Just save 20%. And with that saving, you could save it for a vacation. You can save it for an emergency. You can split up those savings however you want to. But I'm a proponent that you should save up something of your paycheck, right? To not save up anything freaks me out. Like I think just because I grew up poor and I'm used to having an account that was like at like $0 when I was in college, like $0 to $200. That was my account. Like nothing, no money to do anything. Until I got a job. And then when I got the job, you know what I did for my first job in Bozeman? I worked for $8 an hour for 20 hours a week. So let me show you this very fast. So, okay. 8 times 20. Okay. 160 times 4. That's $640 a month to spend. My rent was $360 a month because I did a room. So you take well, I don't even know what taxes were, but taxes took it down to probably like $600. So like this is to subtract 40. Okay, and then my room was $360. Okay, and then my food was about $200 because the meat is really cheap in Montana, and I also hunted. So I had like $40 of disposable income. You know what I did? I took about half of that to save, and I used it to go on little trips with friends every now and again. You know, now I was a college student, so I pretty much did everything, you know, at school. So school was my life at a certain point. But you know, I also got tips every now and again, which was kind of cool. But you know, again, that's a brute example because it's a part-time job, but I still saved during that because I wanted to go use the money for something, or I wanted to have a backup plan. I was on the Obamacare thing in college, and Obamacare was kind of flawed in my opinion because if I would live in Washington, I couldn't actually use the healthcare services in Montana. They wouldn't pay for it, and so since we didn't have any money, like you know, insurance costs a lot of money every month. Once my tooth messed up, I had like a molar. Imagine a wisdom tooth growing into the molar, then decaying it from the inside out, even though the top of the tooth looked perfectly healthy. That's what happened to my tooth. And I was in pain for like 2 months, like straight, like just on drugs that I buy, you know, like over the store counter drugs because I couldn't literally get myself back to Washington to go use my health care, you know, for a dentist appointment to get the tooth out. So I was able to get back on Thanksgiving to get it out. So what I did is as it decayed and the tooth kind of opened up, I packed ginger, cut up ginger. I think ginger or garlic, one of the two. It's like anti-inflammatory, and you just stick in the little hole in the tooth that was decaying. And so I'm a very resourceful guy, but you know the savings goes to stuff like that where I could pay the after even with insurance, you're still paying for stuff here in Washington. And then once I got a job, I kind of lost all the benefits of like Washington stuff. Because I made too much money, but I still save up like even to this day for stuff like that. Even though I really don't have many crazy expenses these days since I moved out of the city. The city causes you to spend money. There's just no way to not spend money if you live in the downtown areas. Let's see, but guys, we have 5 minutes left until the rate hike comes. And hey, Richard, happy to see you back, my man. Yeah, I mean, people just don't like to save. It's just very weird. I don't understand it, but I do understand it, but it's just very weird to me at the same time. Because there are so many different sources out there these days that kind of teach you and kind of help you. But I just think people, it's so out of the ordinary for people these days to actually be like, whoa, I can't spend all this money that I've been spending before. I got to save it. No, I'm just going to have my best life. And people like, dude, guys, if you want to have your best life and don't want to save, I'm not going to tell you what to do. I'm just telling you it's freaking weird from my perspective. But, it's always weird. Let's see. And hey, Alex, I wish I would have been saving and investing when I was about 18. Yeah, I mean, it does make a difference. It really does make a difference. Start up your Roth IRA soon. Start putting money into it since there's a max for it, right? So, but even now, with all this big kind of downward move, I think we're going to be happening in this next couple quarters. That gives you an opportunity to buy for the long term. That's why I keep on telling you guys, hey, don't be afraid to buy these dividend plays. Don't be afraid to buy this dividend. Over time, they're still going to make you money. Like, people seem to always forget that Apple has dividends. Buy up some Apple. Apple's going to be just fine over the next few decades. Going to be fantastic. So, as long as they're doing fine, I'm going to continue to get some dividends. I used to own a lot of Boeing until they had all their issues and my stop loss finally hit. And it's rare for a stop loss for me to hit on a long-term asset, okay? Just take the opportunity to at least get some dividend plays in your portfolio. Because it's always nice to have that monthly thing that says, hey, you've had some dividends placed in your account. Would you like to reinvest them, or would you like to put them in your account, like your typical account balance? I typically do account balance. Sometimes I do reinvestments, but you can choose which, what you do for each individual set of dividends that you get. I love that. I absolutely love that. So, it's nice to have dividends rolling in every month or every other month. Sometimes, not all dividends come out like, it's not all like Monday. It's not like it comes out like January, February, March, April, May. It's like January, March, maybe April, but not May, maybe June, but not July. Not August or September, but maybe October and November. It's not exactly balanced. See, hey, Mega Tony, happy to see you back, man. Saving money is like making money. It's not how much you make, but how much you save. It really is about how much you save. I just like having a bank account where I can just okay, I can go buy whatever I want to go buy at this point. I don't really keep much money in my main bank account. Most of it's in savings or just in like long-term portfolios. I'm just kind of waiting it out, but I have access to get the money back if I need to. Again, I don't spend a lot of money. The last big purchase I did, like even when I bought pizza and everything yesterday for my folks or my mom and sister, I spent like $50 on the pizza, stuff like that. So like $125 for my prescription pills. I have Adderall today plus some anxiety medication. But I guess maybe $50 for one night's pizza for one night for the family is kind of crazy. But I mean, my mom got us Uber a few days ago, Mexican food, Uber Eats. That was $70 for 3 people. Are you kidding me? Like Uber Eats seems like the biggest scam ever. I can't imagine spending that much money on food. I'd rather just go drive and pick it up. Like even my mom was asking me yesterday before I decided to just give everybody pizza. She called me up and said, "Hey, you want to come over and get some Taco Bell?" And I was like, "No, I don't really feel like Taco Bell." She was like, she asked me how much the boxes are at Taco Bell, like the little deluxe boxes. And I was like, yeah, let me check it out. The deluxe box at Taco Bell right now, the one close to us, it's like, well, I guess the one close to me, it's like $10 for a deluxe cravings box at Taco Bell. $10 for that shit. No. And we got 1 minute until Jerome Powell speaks, so we'll be watching this. You should see some more volatility here as far as the market's concerned. But yeah, scary. $10 for a deluxe cravings box? No. So I went to the store. I got the stuff to make dough, like flour, yeast, pepperoni, mozzarella cheese, some pizza sauce, some jalapenos, some onions. Yeah, that's all that was. That's it. And that made a good pizza. Really nice and easy. Oh, and some olive oil. I can't forget the olive oil. Let's see. Hey, no worries, Aaron. Happy to see you back, man. And hey, Alex, my buddy saved around $10,000 or $100,000. He passed away, left his money for his nephew who he hated. Oh, geez. Nope. I guess mine would probably go to my sister at that point, but geez, no, I would be spending a lot of that. Well, it depends. If it was his like lifetime savings, maybe a little bit different. Hopefully, I don't have to kick the bucket too early. My buddy, Sally Mae money market, not bad for short term, a little over 3% interest. That one's also pretty good. I mean, you guys could always go to like what Goldman Sachs, they tell you what they're buying, and you guys could always go for those ones as well. Those are low, high growth, low dividend plays that usually outperform the market. They're usually pretty good at picking their trades. So you guys can always go to Citadel, Goldman Sachs, JP Morgan, see what they're buying and just putting their money in. You guys do the same thing. They're not going to let that sucker fall. They're not going to let those things fall. He should be speaking in a few seconds, everybody. I love corn on pizza. I don't think I've ever had corn on pizza, but it does sound interesting. Oh, I forgot ham. My sister specifically said she wanted ham last night. Oh, no. So I got sausage. We got sausage instead. I bought some Hempler's sausage spicy. Then we poured a whole bunch of red pepper flakes on it and made it really spicy. So even though the sausage was really spicy, as you ate it, it gave you a warm heat. And you can see Bitcoin having a little bit of a drop right now. NASDAQ's falling. SPY's falling. NASDAQ's actually pumping up for the day. NASDAQ went positive. What the heck? All right, we're waiting for the conference here, but let me just go over here. What's going on with the NASDAQ? NASDAQ is not positive. What is going on with TradingView right now? Daily chart. Maybe it is. This is weird. 5-minute chart. So it had the drop, popped up. Now it's coming back down. What popped? It's crashing now, too. What the heck is going on with the NASDAQ? Now it's back to negative. Did the SPY do something similar? No, SPY... Oh, it did have... The timing is off, though. What is going on? Whoa, 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 whoa. Is the dollar index going back up? Yeah. Bitcoin, yeah, what the heck was that? Who bought up the NASDAQ here? It's still much higher than that drop we had. Okay, he's speaking.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. Yes. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path.
I think he wants to see under 3%.
Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
We're going to have more rate hikes.
We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris.
Chris Rugaber, the Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%.
Never mind.
And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So yes. I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed, demand is shifting back to services, and shortages have been abated. So you see that in the other.
The markets are pumping right now, guys. The markets have started to pump after a volatile moment.
We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December jolts this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in jolts has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and you know, quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think, you know, we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services X ex-housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together, although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature, it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Oh, geez.
Howard Schneider with Reuters, and thanks as usual.
It doesn't bode too well for the rest of the year,
Connect
basically.
a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's, around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down. This is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, The Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
Went straight for the
So
question.
we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
Well, you'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy. And
damn, this is a good reporter.
I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria. Hi, Chair Powell. I wanted to ask about the debt ceiling, given that we've...
Yeah, Aaron, it's probably going to be 2 more 2.5s.
Against it. I was wondering, if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we... Say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about... You're asking about prioritization, in effect, is what
yes,
you're... Okay.
Yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina and then Steve.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
Somebody already asked this question.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're going to write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and I mean, you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, you're right. If you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the.
What city is going to do tax cuts? Tell me now. What city is going to do tax cuts? Come on now. That's ludicrous. Ludicrous.
Factors will help support positive growth this year, and that's my base case is that there will be positive growth this year.
Rich.
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months, that we've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence metric?
I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. Market participants have a very different job, and it's a fine job. It's a great job. In fact, I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will complete this task because we think it has benefits that will support economic activity and benefit the public for many, many years.
Edward.
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come to go from 6.5 to 2?
I don't think we know, honestly. You know, so we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's come down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down and Congress did what it did and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer. It's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, you know, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, you know, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great, but we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
You know, so my forecast and that of my colleagues, as you will see from the SEP, and I mean, there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. You know, if that happens, if inflation comes down much faster, you know, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession, and we have inflation moving down. Into somewhere in the mid-3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if we get if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy saying, of course.
Scott.
Hi, Chair Powell. Scott Horsley from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
That's the general sense of it. Look, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, we've kept that statement in there for quite a while, and I think we knew we would take it out at some point. There's never a perfect time, but we thought that, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in the Fed's monthly post-meeting statement as an ongoing economic risk, as opposed to, a health issue.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Wanted to go back to another thing that Fed Vice Chair Lael Brainerd said recently. She said she doesn't see signs of a wage price spiral. And I'm wondering if you agree with that.
I do. Yeah, I do. I don't see that yet, but the whole point is, if once you see it, you have a serious problem. That means that effectively in people's decision making, inflation has become a really salient issue, and once that happens, that's what we can't allow to happen. And so that's why we worry that the longer we're at this, and the longer people are talking about inflation all day long, every day, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are, we pick that up in conversations, and I've seen some data too that show people are, gradually, they're glad that inflation's coming down. People really don't like inflation, and as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. Is consumers and businesses that essentially. We believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. And in this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Greg.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast, but our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Let's go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer, faster to that drop-dead debt ceiling deadline. Could it play an effect as we get closer to that drop-dead deadline this summer?
It's very hard to think about all the different possible ramifications, and I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up. And we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
Okie dokie. Okay, there we go. So that was Jerome Powell, everybody, pretty much giving a pretty dovish speech, actually very more optimistic than I thought he was going to do. Hello. Sorry, Loki's over here. He wants hugs. He probably heard me shout into the microphone. It was a very interesting talk. We only had a 0.25 basis point rate hike today. And on top of that, the market really did enjoy it. We did see when the announcement first came out a big drop, but then afterwards we just started to pump up. I think people weren't entirely sure what to make of his statement when the Fed meetings actually came out. The thing that worries people is maybe he's going to do more rate hikes than he previously said. But if we're going to go off of what he's talking about right now, we probably have one more 50 basis point rate hike or two small 25 basis point rate hikes. That would take us into March and May. Okay. Now, I think if we have one in March, we're probably not going to have one in May, because by then I would assume the economy is starting to teeter a little bit, and we're just not going to see that last hike, so to speak. He talked about inflation in different sectors, and I do agree with him that certain sectors are, definitely still getting hit by inflation. I think that, he's probably going to over-tighten us into a recession just to loosen up the labor market. I just don't think it's going to be a catastrophic recession, if that makes sense. What's the alternative to not raising the debt ceiling, the U.S. filing for bankruptcy? We're going to raise it. It's pretty much what do Republicans and Democrats negotiate on as far as price cuts. So, our country has so much wasteful spending. It's like modern corruption is wasteful spending, Like when in California they spent like $1 million per tent or on a mini house. All that money didn't go to all that one house. You get what I'm saying? So, that's the way our system has kind of been built up, and I don't know what they're going to be able to try to claw away from these bureaucrats. Remember, most of the money from the government goes to bureaucrats to go manage a lot of the stuff that we like in our day-to-day lives, like what potholes get fixed, how do we get taxed, that type of stuff. I don't know how much they're going to be able to get back from it, but I do believe there's ways to get money, to not spend as much. I think there are. It's just going to be some shrewd negotiations. You better have your best negotiators on both sides in the room to talk. I think McCarthy has a meeting with Biden coming up, so maybe we have more clarity of what they're going to be going for. But at least at this point, Biden has had this firm stance that he's not going to negotiate at all. No negotiation. And if there's no negotiation, the debt ceiling is going to get hit. Biden's going to have to give up or capitulate against Republicans on that fact. He's going to have to negotiate. He's just going to have to. I would have never taken that stance to say no negotiation. I would say, fine, we can negotiate, but it's not going to. You're not going to get everything you want. I'm not going to get everything I want. We're just going to pass the bill, but the debt ceiling will go up, and everything will kind of go on hunky dory. It's going to be very interesting to see what happens during this meeting and how the Democrats and Republicans kind of portray what's going on here. I'm assuming duck meat is for those that have made good trades and or investments. I always forget how much. I've never really bought a whole chicken. I don't remember the last time I ever even bought a whole chicken, but a whole duck with the head, the tail, everything, like not, obviously, raw and the feathers plucked out. A raw duck normally costs about $17 to $22. That's how much I pay for it. It's not crazy expensive if you ask me, but I just don't remember. I think it's probably crazy expensive compared to a chicken. I just don't know how much chickens cost. But I also don't like chicken meat as much as duck meat. Duck meat has more fat, and so the fat kind of melts in a different way, so it's a different type of fat. I like chicken, but I usually like fried chicken wings or something like that, right? Still learning, so it's chicken for now. Hey, chicken's good as well. All you need for chicken is some good seasoning and bake it. Good. I'm a big proponent of baking meat. I love it, or air frying if you want to do it. But something you can do with duck that's really cool before we start going back over here to crypto is you can salt and pepper your duck up, and you can just put it into like a 400-degree oven and just let it sit for hours. While chicken, it'll burn. Duck, it has so much fat that the fat just kind of melts into it. So it's something like pork when you cut into those pork things that you see in the Hawaii commercials, whatever. You get crunch, 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 crunch. You get a little bit of crunch. Not as much crunch, obviously, because it's only in there for like a few hours, not like the whole day or whatever. but it's very, very good. I highly recommend eating some duck. Hey, look, Pink, a whole duck is fancy. I never thought about that because a duck for me like lasts like 2-3 days. Is duck better than chicken? I believe so, but I think it's kind of the flavor you're going for. So I like dark meat in chicken. I like all the meat instead of a duck, but I only like dark meat instead of a chicken. That's the reason I get duck. When it comes to like breast and stuff like that for chicken, I'm like, bleh, bleh. So I usually don't like it. If I have breasts, I will usually take the breast out. I will, so I'll get some like Hispanic spices. So you get, I don't know, like a whole bunch of different chilies. I'll grind the chilies in a grinder, okay? So like fine dust. I'll pour all that into a crock pot. I'll put the chicken breast and all the white meat into that pot, a couple things of water. I will pressure cook it. Once it's pressure cooked, I will shred it. And I will have a beautiful Mexican, flavored chicken. And then I'll proceed to make my own homemade nachos with it. That's what I do with chicken breasts and stuff like that. But with the wings, I'll make a couple fried wings out of it. The document, the drumstick, I'll bake it with some Parmesan sauce or something. It's nice and simple. But when it comes to white meat, I will just literally just toss it in a pressure cooker, separate it all out, shred it up, and I'll use it for taco meat or shredded taco meat, or most likely for me, nachos. You get those little baking pans that are meant for like little mini loaves of bread. You put chips on the bottom, then you put some cheese, then you put some meat, then you put some beans, then you put some chips, then you put some meat, then you put some cheese, then some more chips on top, and then boom, you got yourself a little lasagna nachos working for you. I know what I'm about. I only have those things maybe about once every other month, but gosh, they're amazing. They're a treat. You get some homemade guacamole, some nice little salsa from the jalapeno store across a few miles away. It's great. It's great. It's great. Saying no negotiations is ignorant and stupid. Our government is literally supposed to sit down, discuss, and negotiate things on behalf of the people. Remember, guys, this is a democracy. We negotiate. We compromise. That's like literally what democracies have to do. That's what keeps us kind of in this, without tipping over the edge. So I think he made a stupid decision because somebody told him to, some one of his assistants, and he went with it. And it's just not looking good right now. But I think his approval rating was going up, I think, before all this stuff started happening. So I think it was like 538 is the website for it, right? It used to say how popular was Joe Biden. I guess they changed it. Yeah. So, whoa, why did it go down? So, guys, up through December, it was actually going up to 43%, 44% approved. Now it dropped all the way back down to 42. It just had a big plummet. I don't know what's happening. I haven't been paying attention to. Oh no, he's under investigation now. I just don't watch the news enough. Oh my gosh. But yeah, he's under investigation now for doing this unclassified documents, and I think there was even more documents found or something like that. Let me see. Biden documents, maybe. DOJ searches Biden's Delaware beach home amid classified documents investigations. Let's see. Oh, but it says not found. Not found after the DOJ concludes search. So, what do you call? So, yeah. The DOJ declines to release communication on Biden docs to House Judiciary. That's kind of getting sketchy because I feel like the House is supposed to have oversight. Same with the Senate. Oversight over the FBI. Oversight. Hey, we trust you, but we want to make sure you're not doing anything crazy. It's weird that they're not giving them information. It's always weird when I see stuff like that. So we got YouGov, Biden at 41% approve, Rasmussen 42, Monmouth 43, Morning Consult 44, YouGov 44, 43, 44. You got 40 over here, 41, 41, 45, 45, 38. Wow, 38. So his approval rating is going down a little bit. He just needs to go back to being bipartisan. Remember, he was able to get the infrastructure bill done. He was able to get that Jobs Act thing done at the beginning of his term, which kind of started a lot of this inflation. But, he was able to give checks out to a lot of Americans, like the $1,600 checks again. He's been able to get some stuff done. But that wasn't by saying no negotiations. That was by getting it wasn't even him. It was really just senators and senators getting together and making a deal, then just saying, "Hey, Joe, this is what we came up with. You like it?" And he's like, "Yeah, sure, go for it." But still, he was there to kind of he didn't mess it up. He's messing it up right now. So he just needs to get together, say, "Hey, let's work out a deal. Let people work out a deal and let it be done." Just don't make this draw out, because that's what people get more antsy about this rate hike situation here. It's debt ceiling situation. Chicken is about $2.50 a pound, so depending on the size, maybe $10 to $12 for the whole chicken. I know duck is more expensive. Game meat, as always, is. Sounds good, though. It's very, very good. Loki likes to eat the heads. Hey, Alex. Will the market most likely continue to rally because of this news, or is it early to tell? So it's too early to tell, and that's only because of what happens tomorrow and today. So it's 12:30. If you guys want today is the time to do a YOLO call or YOLO put on Meta. I'd probably do some type of hedge, 5% down, 5% above, a hedge probably on the downside with lower advertising revenue, like what Snapchat was talking about. But here, okay? Today we have Meta's earnings. That's a big wallop of one, okay? So we want to see what Meta's doing. And last time Meta had bad earnings, it just like crashed like 22 freaking percent. Oh my gosh, right? Now, but tomorrow is the big boy. Tomorrow we have Google. Tomorrow we have Amazon. Tomorrow we have Apple. Those are the big kahunas that really are going to drive this market up, or they're going to drive this market down. So be very, very, very careful about what you guys want to invest in, because if they're really good, things will pop. If they're very bad, like we'll go down, and we'll go down hard. Now you can see over here, as far as Bitcoin's concerned, Bitcoin's pumping up right now, but it's still not even testing out the resistance levels from the past few days, right? It's getting up there, but it hasn't really popped up yet. At least at this point, Bitcoin is probably more bullish than a lot of the stocks we're looking at, but at least the stock market as well is still holding above these breakout zones, right? Breakout here is still holding, same with the NASDAQ, same with the SPY, all holding above those breakout points. Now, we are watching the 20-day moving average, but if I go over here to earnings this week, we can come over here to Clippinger there. Let's go to Wednesday, Meta. We also have Aflac, Alliant Technology, Allegiant Travel, Allstate. Anything big here that I really need to pay attention to? Humana, maybe. Netgear, maybe. Old Dominion, Otis Worldwide. Not a T-Mobile, perhaps, but there's not really much here today. Tomorrow is the big dog. So we got Apple tomorrow, Alibaba tomorrow, Alphabet tomorrow, or Google, Amazon. Let's see, Canada Goose. Clorox, ConocoPhillips, Estee Lauder, Ferrari, Ford, Gilead Sciences is a big one. GoPro, Honeywell maybe. SiriusXM, Skechers maybe. Qualcomm's a big one. MicroStrategy if you guys like crypto. US Steel is going to be a big one here. That's probably going to go down. And Starbucks is going to be a big one. And WWE if you guys like that. Under Armour is always interesting, but UUA. Under Armour's kind of weird. Wait, what? Did I get the ticker wrong? UAA. Oops. UAA. It's had a nice little rally over the past few weeks. Oh, I mean, look at that rally. It's come down from 6.4. It's almost 100% increase. See this last earnings report? Nasty. This one over here, not too bad. Kind of went down a little bit, then it came back up. Before that, nice little gap up. So this is used to having some pretty nice moves once earnings occur. But I just look at how crazy this move has been. Oh my gosh. I mean, look at that. It held up here, managed to break out, held up here. I mean, this thing may just want to go to $13. Like, just look at that. Like, I just don't know what's driving this at this point, but it looks great. If it doesn't have good earnings, you can expect another big type of crash like this. But if it has good earnings, you may see it try to gap all the way back up here towards $14. That'd be interesting. I mean, what are we looking at over here? Oh, no, this one's probably not as good. Probably up here a little bit higher. Yeah. 13, 14, yeah. So, I mean, you're seeing some crazy moves right now. I don't know how long this thing can continue. It doesn't make any sense. The economy is like slowing. It's getting worse every month. Worse. But the market goes up. And we're just going to wait to see which one breaks. Will things get better or will they get worse? And if the market's anticipating things getting better, it's not anticipating things getting worse. That's the big point here. Remember, the market is like a future expectation of what's about to happen. There you go. But you can see a nice little mini breakout here, and we're still going up a little bit higher. Hey, Shannon. Honestly, I would go to ChatGPT and have a full-on conversation about what inflation is and what causes it. Because as far as the inflation that we've seen over the past couple of years, it's been like it's not your normal typical inflation. So what happened this last cycle when all this like transitory stuff came up, and the Fed got it wrong, the government got it wrong. They both said transitory, it was not. What you saw was this. You know that when you're dealing with basic economics, you have supply and demand, and that pretty much determines price in a basic sense, right? Well, what happened during COVID is the supply chains were so whacked out that supply was low, but demand was still here, okay? So typically, if there's low supply and the demand is stable, you have higher prices, all right? More people want one apple, it gets more expensive for the apple. But on the other hand, what happened is because the government gave so much money away during the pandemic and the country was opening back up, everybody wanted to spend all this money. So demand shot up while supply was relatively low. All right. Now, during that prices soared, that's what caused the inflation that we're thinking about today. Now, what's been going on over the past year since inflation got very, very bad is demand is still relatively high. It's come down a little bit, but really the supply chain issues are kind of getting fixed up a little bit. And you're seeing supply start to figure itself out. But unfortunately, demand is still high, and that's why we're still having these levels of inflation. Since our supply issues are kind of fixed at this point, not all the way, but mostly fixed, what you're seeing now is the Fed try to go after this high demand. How do you get high demand to go lower? Well, people have to lose their jobs. They have to be afraid of spending money. They have to get charged more for spending money on credit cards, so their debt will go up, right? So instead of spending a whole bunch of money on credit cards and getting higher interest payments, or instead of buying that new house and paying more for that new house because of interest rates, people don't spend as much, so the demand kind of goes down a little bit. We're in the process of demand going down, but the problem is if demand goes down too much, that's where a recession goes into play. And that's the big concern at this point. So I would say go to ChatGPT, have a full-on conversation with the bot. If not, you can always go over to Investopedia and just look up recession. Wikipedia has a great article about recession as well, and the causes of it. But this one was so weird because we got hit with a double whammy. Huge demand from free money from the government, and opening up after COVID, everybody felt free as can be. And then you also had supply chain issues from the COVID just disrupting that entire industry. Not enough truckers, not enough railroad workers, yada, yada, yada. Not enough shippers, merchant seamen. And then now that that's getting fixed back up, we still have to deal with the demand side of things. And you're seeing the slowdown. It's just not enough. But just the slowdown itself means that, hey, we're probably going to go into a recession. That's why I always show you this graph. Sales numbers, charts economy. There we go. So we're looking at the sales numbers. You see how we were doing fine last year? We're going down a little bit. Things are getting kind of more sideways. People are kind of freaking out a little bit with high inflation. Things got kind of bad. This was kind of at the height of the gas thing. So people were just spending a little bit more money, but also just not trying to spend if they could. More antsy. But now we're just going down. And so if I go back a little bit and I turn this into line, you can clearly see sales are going down, right? Now, you want to back this up 5 years, you can see COVID really messed us up. We've had a couple of ticks like this in the past. So the market is, at this point, the market thinks this isn't going to get too bad. We're probably going to go down maybe two more times. We kind of turn around, everything's hunky-dory. But if we go through a full recession, 2008 recession, oh gosh, it's been more than 10 years. Then we might have something more like this, right? Where we have like 5 or 6 months of really bad numbers. That's the recession. That's the really nasty stuff as far as sales are concerned. And then the market picks back up over time. I'm thinking it's going to be something more like this. Maybe not as long. Maybe like 5, 6, something like that. Before it starts to pick back up. But, that's kind of what's going on at this point in time. Jerome Powell is trying to do everything in his power to get demand to go down. Inflation would go down a lot easier if people literally just stopped spending money. Like, if Jerome Powell could come out to America and say, hey, he can't do this because it would mess up with too many industries. Hey, guys, we see the services sector is too hot. Please do not go to hotels for a month. Please do not go this for a month. Please do not go this. And everybody listened to him and didn't do it for a month. The inflationary pressures would go down. But as soon as he reopened it again, everybody would just flock back to the hotels because they have all this money they saved up specifically for hotels. It's crazy. Remember even I'm going to Vegas later on next month. My hotel room is going to be costing me like $66. I got a cheap room at Polo Towers. And then I'm staying half the time at Polo Towers because it's like next to my friend's hotel that I'm staying the other half at Aria. Yeah. So, everything's much more expensive than what we saw during COVID lows. But like that, I think I don't know how much I'm paying for the Aria room. I haven't even purchased the ticket yet. So we go here to aria.com or Aria Vegas, whatever it is. Aria Resort. How do I book? Okay, book a room. Okay, so I'm gonna be there March. So from the 20th to the 29th. So I'm gonna go from here to here because I'm in the Polo Towers for the first 2 nights. Okay, so go here, go to Aria Resort. Okay, so if I get a room right here, I have MGM reward, so I'll probably get something here. It's only one guest, it's me. I just want your typical deluxe king room, nothing fancy. 520 square feet, and you'll see just that right there is $648. 3 nights back in during the COVID times used to be like $300. It used to be much cheaper. Right? So I normally you go to checkout, you go over to here, and you see payment due now $339, due at check-in $395. That's because of resort fees and stuff like that. I'm surprised they don't have the resort fees summer. Oh, there it is. Resort fee and estimated tax $100. Room estimated tax $74. Added onto that. So each room, like Wednesday it's $299 or Tuesday it's $299. Wednesday night it's $259. Right. So that's kind of everything's much more expensive than it used to be. If you guys want cheap places to go, I would recommend you guys go to not on the Strip but Fremont Street. Fremont Street is freaking awesome and it's cheap. They have suites for like $100 a night. It's so nice. If you guys are okay with getting an Uber into town. Okay. Let's see. And it could be oil got a nice rejection. Yeah, the OPEC wants oil to be around this range of $70 to $80. So if it stays in there, they're pretty much happy at this point. They're controlling the markets, and I think their goal here is to just keep it around that point. So let's go back over here. Let's go to oil. Yeah, it's at $77 right now. That's their goal right now. We even had this little breakout a while ago. Didn't really do much because, again, they want to keep it within this trading range. That's all they're trying to do. Keep it 70 to 80. This is 82. But they're trying to keep it in that range right there, and that's their goal right now. So it might even come back down a little bit more over the next few years, or months, excuse me. But as of now, it's in a good spot, and I don't see it getting too crazy here unless, again, the economy starts to get a little bit crazy. Then they're probably going to cut production to keep the price relatively high as well. And you can see Bitcoin breaking out there a while ago. What a freaking crazy move we've had with Bitcoin. There we go. See. What did you say? Chat GPT? Oh yeah, Chat GPT. It's really cool. So Chat GPT. Do I have it open? I have it open on over here. Oh, it doesn't want to open up 2 sites at once. That's okay. All right, go over here. Try Chat GPT. Once you're here, it's gonna ask you to log in with your Google account. It's gonna ask you your phone number to make an account. It's very, very simple to do so. I use it for a lot of YouTube metadata stuff. Give me a description, give me a tag, give me a hashtag, whatever. But you can can you explain inflation to me like I am in high school? Okay. So it looks like it's overloaded right now with a lot of people asking it questions, but it should pick up here in a couple seconds. If not, it'll give me a little warning sign. So it's free right now. So once it's paid, I feel like it'll be a lot easier for people to use it. They'd probably charge anywhere from $20 to $30 a month to use this, and I'd totally pay for it. Sure. Okay. Inflation is a measure of the increase in the average price level of goods and services in the economy over a period of time. Essentially, it means that the same amount of money can buy you fewer goods or services than it could before. Think of it like a balloon that is being filled with air. As the balloon gets bigger, the same amount of air takes up more space. Similarly, as the average price level, and okay, I can't read it slowly like this. As the average price level in the economy increases, the same amount of money buys you less and less, right? I mean, you guys can read that, I think, off the phone. Yeah. It goes on what can cause it. Normally it works a lot faster than this, I should say, but right now it looks like they're a little overwhelmed. So, but yeah, that's a basic kind of reasoning of what inflation is. Now, don't ask it what happened in 2021 with inflation because it only goes back to, I think, to 2020 or something like that. Or maybe it only goes back to 2021. I'm not entirely sure. But, it's important. So, but like maybe you didn't understand that example. You can come over here and say, hey, can you give me another example? I didn't understand. Then you say thanks at the end because it could be a robot that can kill you someday. So just say thank you to be nice to it. You never know. You never know. And then, and then it'll kind of do another little section for you, kind of giving another example there. And again, this is like really, really slow. Normally it's like super lightning fast. But yeah, another, this is $1. So you could say I want it with dollar amounts, right? So pretty chill though. It's really cool. It's free. It's kind of slow right now though, honestly, but I use it for a lot of stuff. I'd recommend it a lot. I was having it help my sister. I was teaching my sister how to use it yesterday when it came to her doing her essays for college. She's applying to college. She got into a college, St. Mary's College. Expensive college, very expensive college. But it's either that or Western Washington University, I think, at this point. My mom and grandmother are pushing her to go to St. Mary's, I believe, though. See, but and it even brings back the balloon here to kind of give you another idea. So it kind of compounds on what it's told you before, and you could always ask it more and more questions here. But yeah, Shannon, it could help you out a lot. Or you can just go to Investopedia and start looking through individual words like longer descriptions. Investopedia is another good resource. But here's that. I think it's called St. Mary's Olympia. Oh, St. Martin's. St. Martin's, sorry, not... I don't know what do you call it? My sister just got accepted here, but I think it's expensive, so I don't know if we're going to pay for it or not. But she got a $75,000 grant to go here, so she's a good student. Wait, they don't... Oh, admissions and financial aid. Tuition and fees, there we go. Undergraduate. Oh, it's not too expensive. Oh, okay. So this is just the tuition. Okay, so it adds up. Oh, total projected costs. Yeah, $56,000. Holy Holy schlot. For a semester? Is that for a year? Semesters. Oh my gosh. Yeah. Okay, that's for the whole year. Oh god, I was like, what the frick is that? I don't know. I know I'm gonna have to help pay for that. Oh man, colleges. Oh my gosh, these days. Let's see. No way, Shannon. Oh, Chat GPT. GPT. G as in gopher, P as in potato, and T as in taco. Taco, excuse me. Hey, Isman, thoughts on inverse finance? It's something I would own, but it was not something I'd probably put more than a few $100 into it. Just kind of see where it goes from here. People have asked me about it a lot, and it seems like it's just been kind of going more sideways, and it's kind of matching the market a little bit. But it's just more of a low market cap play that I would be like, hey, let me toss some money in there. Not my first choice, not my second, not my 10th, not my 20th, but it's something I'd probably own just to see what happens with it down the road. It's more about what they're trying to do. I'm like, hey, maybe if it actually works, they can actually go big, right? And then Mr. Dub, the Flamingo is good until it's cheap right off the center. It has an awesome pool area. I heard about the Flamingo. Like here, Flamingo. Oh, I forgot. You should type in Vegas after Flamingo. I always forget it's actually a bird. Okay, so go over here very fast. So, the only thing I've ever seen of it really has been that front, but it always looks so nice. Book a room here, though. But go over here very fast. March, $69. Much cheaper. Yeah, $59, $60. That's not too bad. I know my friend, he's staying at Harrah's. Harrah's, is that what it's called? And I think he likes that one, too. I'm staying at the Polo Towers. I don't know if they have good pictures on here. This one, yeah. So basically, the reason I wanted to go here is you can see it's like right by Park MGM. They have a pool on top of the building, so I just wanted to see what this is like. But I'm just not going to spend as much time. That's probably going to be my room. That right there is probably going to be my base room. I don't really spend much time in Vegas hotels. It's like, you're in Vegas, you're supposed to like not be spending any time there as well. But I think the Aria is right here, so literally I walk across the street when I transfer hotels. But it seems pretty nice. Like even the last time I went to Vegas for that work thing, as far as October, I didn't really spend it at a really fancy hotel. I did spend a lot of money, but it was on Ubers, and every single Uber I took was an Uber Black Escalade trip or like a Suburban trip, and it was just great. Or a Mercedes car. Yeah. I was living life in Vegas. I love spending money when I go down there, so that's like my splurge. But I don't usually spend it on hotel rooms. I spend it on everything else but hotel, like the food and the glamour, the shows. You know what I mean? But last time I was there, I saw the Golden Gate. There was like some history behind this hotel, so I was like, oh yeah, sure. Let me go try this place out. And it was really, really fun. I had never stayed at Fremont Street before. But this one's really, really cheap too. This is not on the Strip though. This is on Fremont Street, which is why I normally don't go here. But like $24 a night. Last room I got there, got a suite like this. Remember, I even showed a video of it on YouTube. You get a whole little suite, and it was like $100 a night. It was $100 one night, $50 the next night, $50 the next night. Very, very easy. Except for I cut myself really bad on something. Oh, I had a fresh new shirt I brought, and like those little pins that come out of dress shirts. I just like totally sliced my finger open with it. Got blood all over my white shirt, and I was like, I didn't even get to wear the white shirt the entire trip. I was like, oh, okay. Wore a tan shirt. Still looks okay. Yeah, no worries, Shannon. M-Dub, for a split second, I thought you were suggesting flamingo instead of the duck or chicken. No, that would have been interesting. No worries, Bideford. Always happy to help you guys out. I did like the way Bitcoin really zoomed off today. That's really a really strong look. It was kind of scary in the beginning, but a typical breakout, heading back up for some levels of resistance here. Meta earnings coming up in about 10-15 minutes. That's really going to be the guide here. Snapchat is still doing very bad after its earnings as well. I'm looking at that on CNBC. So that's what concerns me as far as Meta and Google over the next few days. Look at Snapchat, guys. Earnings up here, pop, woo, and just crash. It's had a decent rebound though, but it's just ouch, 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 ouch. See you guys. So this is yesterday. This is after hours. Excuse me. Earnings kind of fell down towards the pre-market a little bit, bounced back up, and here we go. We're back up a little bit more. But yowza, guys. Snapchat got hit hard. It's down to $10 basically. It was actually at $9.74 a while ago. So, but we're hoping that. So if Meta has decent earnings, maybe this will help out Snap. That's what people are buying it right now. So if you guys wanted to go with Snap, you guys can. But if Meta has bad earnings, this will kill Snap tomorrow too. So just be careful. But if I was going to be buying some Meta puts, Meta plays, I'd be doing a hedge with puts being in the favor for expiration date of this Friday. So that'd be my play here because it's going to move up quite a bit, I think. There we go. But relative, it's still higher than it was at 733. Never got down that low again. It all depends on which asset you're looking at. So don't just look at the indexes. Also look at some particular assets that have really plummeted off the face of the planet, like a Meta did a few months ago, like with the some of the other plays out there. I always forget some of them, but yeah, you guys get what I'm saying. ChatGPT can't guess the future. No. I don't use ChatGPT to try to guess the future. It only knows data up to 2021 or something like that. It's 2023 now. When it comes to ChatGPT, it's for helping you just kind of get some basic stuff out of the way and save you time. I would say it's more of an assistant than some type of thing that does all the work for you. So like here, hey, I am making a YouTube video on a topic on investing. Can you help me think of a good lesson I can teach my YouTube class? Teach my YouTube class. Something about risk management. Can you give me a few ideas? Like that, okay? So maybe I have like an idea in my head, but I'm like, I need some other ones. Understanding and assessing risk, teaching your audience and how to identify and assess your different types of risk involving investing, such as market risk, credit risk, and inflation risk. Diversification. Explain the importance of diversifying investments by spreading money across different asset classes, industries, and geographical regions to reduce overall risk. Asset allocation. Investment time and horizon. Understanding the trade-off between risk and reward, monitoring and adjusting investments, professional advice, right? Discuss the value of seeking professional advice. There's a whole bunch of ideas that I could make really good videos on, right? And, I probably wouldn't have even thought of that. You guys know me, I have ADHD. I take Adderall for it, and, it works. But, sometimes it's just nice to kind of have that, right? It's just nice to be able to say, hey, I need some help with some ideas. That's really easy. That gave me a lot of good ideas. Can you give me a few ideas for topics for a video teaching how to set up indicators on TradingView? I'll just say setting up indicators, right? So here are a few ideas for a video teaching how to indicators. Overview of technical indicators, like a very basic one. Trend indicators, average trend lines, moving averages, right? Momentum indicators, RSI, stochastic oscillators, interpreting volatility indicators, Bollinger Bands, true range. Pretty darn useful. Back testing, combining indicators, customizing indicators, importance of discipline. It's very nice and easy. I really do enjoy it. I cannot explain how much I truly do enjoy this. It is fantastic. Whoever made these people, they've done a lot of good for humanity. I really do enjoy this. It just speeds up my workflow a lot. So I would encourage you guys to check it out if you guys haven't already. I know it went viral a while ago, but it really does have a lot of important uses if you guys do want to learn some techniques or just want to help yourself learn. It can even help you learn how to learn a new topic. So you could try to build a course out for yourself to teach yourself, and it can build out the course for you, bit by bit, not the whole thing at once. See, and hey, Axel, do it if you get a chance. They're making an app pretty soon, so that might make it a little bit easier for you. You might just sneak into the bathroom at work and do it there. Yeah, what do you call it? Make it a lot easier. What's it here? But yeah, guys, it's not too bad. I hope you guys enjoy it. We should have a lot of fun here. But I'm going to call it a day, everybody. I need to go get some breakfast. I took all my medication this morning without actually any food in my stomach, so I've been nauseous this entire stream. You guys can't tell. But guys, if you're close to a computer, if you're close to a TV or your phone, go over and make sure to watch Meta's earnings over the next half an hour, okay? I don't know when the call is going to be, but they should have earnings about 5-10 minutes after the market closes, which is going to be in about 5 minutes. Keep an eye out for Meta. Meta's going to really tell us where we're going tomorrow, and I believe tomorrow is really going to tell us where we go for the next month or so, okay? We really need to see Google have strong earnings and guidance. Apple, good earnings. Guidance is key. And then, of course, Amazon needs to have good guidance as well. If Amazon sees sales sliding, that's not good. If Apple sees sales sliding, that's not good. If Google sees ad revenue slowing down, that's not good. All right. And today, if Meta sees growth slowing and ad revenue slowing, that's going to be a very bad thing. Okay. We need to have some good news here. Okay. All right. And it was a 0.25 rate increase. Okay, for today. That was 25 basis points. 25 basis points with possibly 2 more 25 basis points to go.